Hey, what's up, good people? The Fed did it again. The market literally started selling off as he was taking his seat. The market did not want him to talk today, and it began to tank. As you can see here, Dow sheds 500 points. Sell-off intensifies as Powell comments on higher rates spook investors. All right, and what's crazy is this is the same stuff that we know. It's the same stuff we already know. And it is crazy. For those of you that's new to the page, go ahead and hit the like, subscribe, notification. Those of you that's been rolling with me for a while, go ahead and hit the like button. Make sure you check out the links below after this is over, okay? But let's get back to the business at hand. I'm going to play something I want you guys to listen to, and then we're going to comment.
I guess the risk always was even higher, even faster, and for even longer. That's kind of what he said today, is the possibility.
Yeah, and that we're also going to be data dependent, right? And so we have a lot of data. We talked about this last week. We have a lot of data that's coming this week with jobs, CPI, PPI, retail sales next week. That's going to be very important. But honestly, Scott, I don't think a lot of what he said was that surprising. We've been talking about the economy doing better, right? Led by the consumer, and he cited consumer spending. We know jobs have been white hot. They continue to be white hot, which this is why the Friday number is going to be super important. He also talked about manufacturing improving in January, which is a bit of a surprise, right? Because that has been some part of the economy that hasn't been that great. And then he talked about inflation, and we've been talking about inflation whatever way you want to measure it. CPI, PPI, core PCE, unit labor costs. He mentioned services ex housing several times. We know the last reading was a 7.7% rise. So we know that that part of the economy is the problem, and it's going to be harder for them to change that.
Higher, faster, longer. Interest rate hikes. Higher, faster, longer. Instead of 5%, 6%. Somebody even said 7%. It's all over the place. And then you have jobs that's coming this Friday. You got jobs coming this Friday. And then next week, you got CPI and PPI, right? So you have all of this. So the Fed is telling you higher, faster, longer with interest rates. And then he turns around and says, we're data dependent. Well, the truth be told, he's behind on the data. He just, it doesn't make any sense. And, I try not to be overly critical on the Fed because it is a difficult job. But the fact remains that he blew it. He was late getting in, and he's going to be late getting out. OK. And, you may disagree with me, but like I said on this morning's live, just rip the Band-Aid off. While the economy is still strong, while jobs are still strong, now there's more and more companies that are laying off now. OK, yeah, a lot of them are in tech. But the truth be told, an engineer can lose a job on Monday and by Tuesday lunchtime have a new job paying the same amount or more. But you know what? The average worker don't have that pleasure, right? And then we have a lot of jobs that's being hired, especially when it comes to hotels and that type of deals and restaurants. But what industry got hit the worst? Hotels. My wife worked for a company that had 14,000 employees. They got hit the hardest. So, of course, they were the last to start to fill the jobs. But that's not a good read on where the economy is today because they got hit the hardest, right? They had to lay off way more than half of their entire staff, all right? So we got to look at what numbers really count. And the jobs numbers, I will tell you, are skewed. Of course, restaurants, that type of deal is skewed. Everybody's traveling right now. All right. So you think the economy is good because everybody is traveling right now? That's revenge travel, right? Just last year, savings was at an all-time high. Now savings is low. People are traveling, but they're putting it on credit cards. We are in serious trouble. Now, listen to this.
I think it was interesting the way he kind of explained how his view has changed because of the data that we've been talking about almost every day from January. Not only did it come in hotter than expected, but it was those revisions. And Governor Waller gave us a bit of a curtain raiser on how that's affected Fed officials, basically saying, the data's changed, so the outlook has changed. And that's why you get this idea that if the data remains the way it has been, when the Fed goes to pencil in a new terminal rate in March, it's going to be higher than they previously put in there. And I don't think the market was quite prepared for that. I think they were prepared for the idea that it could be higher. But what it wasn't prepared for is the idea of a more rapid pace, the idea they go back to 50s. And Scott, I just want to go through, it's a little complicated, guys, but if you could put up the probability changes that we've seen, what's happened now is you have, and I'm going to put my glasses on to look at this, Scott, 56% probability they go up to 5.25, and that's more than double the percentage it was before the speech. And then a 93% probability you go to 5.25, 5.5, 71% probability you go to 5.5, 5.75. You can see all of those percentages are substantially higher. So what the market has now baked in here, Scott, is, as you said at the top of this segment here, higher, longer, and perhaps more rapid. He just said again that if the data continues to come in the way it's been, we could get there more rapidly.
So at the time of filming this, you could see the Dow is down 553 points. It is down, right? Let's go back over the last let's go back over the last month. As you could see, we had a low, right? We had a low on March 1st. You could see that. Right? Now we're trending back down with the Dow. And I can guarantee you the S&P is the same thing. Look at that. Right? Last month. Trending down. We were here on March 1st, and now we're trending back down. Remember when I told you guys that we don't necessarily get excited when it goes up like this and then it comes down? Remember I was just talking about that in an earlier video. And then when we get excited, it's all over, and then it's another leg down. Then we get excited, it's all over, another leg down. But when you zoom out over the last month, it's just been this steady stair step down, right? And then we had this big pop here on March 1st. And then, okay, yeah, the bottom is over, and then another major leg down. This is called a bear market. And the truth be told, the Fed has just blown it. Now he's scared of disinflation, right? Now he's scared of stagflation. He's scared that inflation keeps rearing its ugly head back up, and now he has to be more aggressive. But he doesn't want to be too aggressive to, for sure, put us into a recession. Okay, let's go to technical recession. Basically, I believe that we are still in a recession. But let's go to textbook recession. 2 negative quarters of GDP. 2 quarters of negative GDP, right? And so I believe that we are in it. I believe that they're going to come out one day and say that the true recession started in January of 2022. But let's go textbook right now for all intents and purposes, right? So now he doesn't want to give us that another leg down. Well, like I forestated, the longer he waits and inflation keeps going, ticking higher and higher and higher, we're going to see what CPI next week is going to be, Consumer Price Index, and then PPI, then the very next day, Producers Price Index. If that inflation is showing that it is still hotter, and we just heard what he's saying, which he's been saying all along, then that's not going to be good for the market, right? So now he's going to be forced to make a decision. If you ask me, and I like Steve Leisman, he said, hey, we've been saying this here, like the Fed doesn't know, but we've been saying it here. You guys caught that the way he said that, right? And he's true. Like, they have the data. They're reporting off of what the Feds are telling them. And they have the data and they could see it, but the Fed couldn't see it. I'm just really ticked at the Fed right now, man. I've been ticked for the last 2 years because he's behind and he keeps saying we're data dependent, but he wasn't when he was printing money. All right. So we are in trouble, man. Our debt is out of control, right? Savings have dwindled and everybody's charging things on credit cards. What the Fed is going to be forced to do is get his money printing machine out again and start printing money after he forces us into a late recession. And I'm going to tell you guys that don't know anything about recessions, that's never been through a recession, it is better that we have it now than later. Just think about this. You piss a dude off, right? You bump into a dude and he's about your size, right? But he been working out and you haven't. And then, you know what? You call the police, he goes to jail for a year, right? Now he's working out. Now you see him, now he got jail muscles. He already has some muscles. Now he come back with jail muscles. Now you going, man, I should have squashed this earlier. Now I got to deal with this dude with jail muscles. Well, I got news for you. Inflation is jail muscle dude, right? And he coming to spank us. And the same thing with recession. It's better that we deal with it now than to wait. He talked forever and a day. You can go on and listen to him talk and answer these questions over and over and over. Sad thing is, we got CPI coming when he tells, when we see where inflation is, right? Then we got the FOMC meeting, which he's going to start talking and taking questions again. Now, the question is this the leg down? The way this market is, nobody knows. But I'm going to guess not yet. I'm just going to guess not yet. So what did I do? I'm looking at energy right now. And I started to buy a little energy. I started buying a little, you guys know, EOG, but I added some Devon to my positions, ticker symbol DVN. I added some Devon to it. You guys leave me a comment on where you think the market is. Do you think it's overly done, right? Do you think it's a buying opportunity? Do you think we're going to rebound from this? Is this correct? Oh. Good people. Oh, this is the month. I looked at this and almost lost my mind. I thought the Dow was down 1,200 points. I'm not editing this out. We're still not doing well. It's down 561. I thought it was down 1,200 points. I was going to just start screaming. Ah! I don't even scream that high. But sometimes all you could do is shake your head when you got this much red. It's a bloodbath. Listen, if you see opportunity and you think this is a buying dip, you guys let me know. Like, let me know what you think. I think it is, but I'm just going into something that I don't think will tank much lower than it is now. And I'm going to continue to add to my positions on red days. All right. You guys make sure you check out the links below. Everybody's loving the class. I just released new lessons in the class. You got Mumu, 17 free stock, deposit a minimum of $100. You're going to get 7 free stock, and then Webull is deposit $1 and you're going to get 12 free stock. Okay, I'm going to leave it right there, good people. I'm just baffled. Like, Steve Leisman said it better than anybody. Like, we've been talking about this. We've been showing you guys this data, and he act like he doesn't know, right? We're going to leave it right there, good people. Leave me a comment. Tell me what you think, man. I'm just exhausted with this right now. I'll see you guys tomorrow. Live, love, laugh, and learn.